Okay, so today we're going to be talking about the free market. Okay, it's a type of economic system, basically the kind you see here in the United States. So, market economies, basically how they work is it's a way in which individuals like me and you can basically use our individual choice and voluntary exchange to get all the needs and wants that we have. So basically, we're going to act in our own self interest. So doing what is best for us. This is not only just consumers, people that are buying things, but also the people that are selling things. So this system allows for a lot of freedom for individuals to pick and choose which items they want to buy and basically who they want to buy them from. It allows companies to decide what they want to make and how they want to make them, how much they want to sell them for, and things like that. So, what is a market? Okay, basically, all you need to have a market is basically somewhere where buyers and sellers can meet. So, in the picture, you see basically a farmer's market, but it's basically anywhere. So, as long as there's a free market in place, so where someone can just show up and if they want to buy something they can, if they just want to window shop, look around, not buy anything, that's fine too. It has to be free, so basically no one can hold a gun to your head and tell you you have to buy Lucky Charms when you walk down the cereal aisle. You have all the options to choose from. Okay, and if both parties can't agree, the buyer and the seller, if they can't agree on a price, then they should be able to leave that market and basically not have to um, buy or sell their goods. So it could be a farmer's market, it could be going to the store, it could be online markets now with eBay and Amazon, all the online shopping methods. It could be um, trading posts on Facebook, meeting somebody in the Walmart parking lot and buying and selling something. All you need is buyers and sellers, and that's it. All right, so some key features. Private property rights. Okay, here in the United States, in any free market, you have the right to own property. So when you have your house or your place of business, okay, that is your place, and the government cannot basically take control of that. Okay, unless you do something really, really wrong. Okay, as long as you pay for it, pay your bills, that's your property, and you have the right to basically restrict people from being on that property. Okay, another key feature. Limited government, so laissez-faire. You've probably heard that before from U.S. history, but basically that the government should not interfere within this marketplace. We need as little government interference as possible. If you allow everybody to act in their own self-interest, the idea is that the market will regulate itself. If a seller wants to sell their product for too much, too expensive, make it too expensive, then people won't buy it. And so what will happen is that place will either figure that out or they'll go out of business because you'll buy some from somebody else. Okay. And then voluntary exchange. Again, open freedom to buy and sell what you want. And it's all voluntary. It's all up to you whether you want to agree to that price or that seller wants to agree to that price for y'all to make a deal. Okay, so why do they exist? Okay, the reason we have markets, okay, today is because we're no longer self-sufficient. So if you think back to those individuals that were settling in North America, they didn't have a Walmart down the street that they could just go shop at. They had to basically make everything and become self-sufficient. They had to grow their own food, make their own clothes, build their house, things like that. As we've gone into a more modern society, we've seen that workers become way more specialized. So, meaning specialized, meaning you concentrate on getting really good at a few things. Think about when you go to college, you pick a major, you take a bunch of classes to make you really good at that one specific thing. Okay. The reason behind that is basically it'll help our workforce become more efficient. Instead of you going to your job and needing to be able to do all kinds of stuff, if you can concentrate on just a few key aspects of that job, you're going to be more productive. And overall, as an economy, we should be able to produce more when we have a workforce that's very efficient, okay, and not wasting a lot of time. So because of that, we need places to, you know, go buy food, go buy clothing, things like that, because we're not all sitting at home or and growing our own food. We're not, we don't all have cows and chickens and stuff in our backyards. Okay, so we have to have these places where we can go out and get all those needs and wants, because our our job, our workforce is so specialized in only a certain few things as we move into this modern economy. Okay, and then also you just look at where people live. Okay, urban developments like this picture here, where houses are just jam packed into tiny square lots of land. You simply don't have the room to be self sufficient. So we have to have those places for exchange so that individuals can go out there and get all the things that they need and want. All right, so who participates in the market? All right, we have two groups. All right, we have households and we have firms. All right, households, this is me and you. These are workers, okay? And what we do is we own factors of production. Remember, land, labor, capital, we own those, okay? When you go to get hired at a job, you sit down for an interview, you're basically negotiating the sell of your factors of production to that business, okay? When you agree to get paid a certain amount of money for a job, you're selling your labor. You could be selling your human capital. You could be selling physical capital. You could be selling land if you have land that has a natural resource on it, oil, lumber, gold. You could be leasing that land to somebody to mine for those things. And you're the seller in this scenario, okay, the household, because you are selling the factors of production that you own as an individual. Okay, you're negotiating. The firms are the buyers because they want to get it at the right price. They want to pay you the right amount, so you work for them, but they're not losing money. They can still make money. Okay, so households and firms. Okay, firms are trying to basically buy your factors of production so that you can make products for them that they can then turn around and sell to other people. Okay, so here in a minute, on couple slides, you'll see it's one big circle of how the money all kind of revolves around here. So, all right, the factor market. Okay, the factor market is when the households, when you guys are selling your factors of production. Okay, you're selling them to a business, you're selling your labor to a business, and they're going to pay you. Okay, well, in return, that business wants you to work for them or create products, create services for them. Okay, so you're going to go to work, they're going to pay you, and you're going to create a product for them. Okay, on the flip side, okay, now that you've created that product for them, that business, they want to turn around and sell it to somebody else. Okay, so they're going to turn around and sell that product or service to other households, and they're going to exchange goods and services. All right, so you can see it right here. So up here at the top, this would be the product market. So you see goods and services from firms, they're being shipped back out to households, and those households are going to pay for them. That's this consumer expenditure. This is when you go to the store and simply buy something. Okay, down here, this is the factor market. Okay, the factor market is on the bottom. So as a household, you're the seller. You are selling your labor, you're selling your land, all those factors of production, you're selling them to businesses. And in return, those businesses are going to pay you. Okay, they're going to pay you those wages, those dividends, rent, whatever it might be. Okay, so now you're making a little money. Okay, so in both cases, one of these groups is making money and one of these groups is buying something. Okay, so product market, okay, households are buying products from businesses. In the factor market down here, okay, businesses are buying factors of production from people. Okay, they need people to work for them. Okay, so you can see how this money just basically goes in one big circle. Households make money, okay, for going to work, and then they turn around and spend money. Okay, those firms take the money that's spent, okay, and they hire more people. Okay, more people make more goods. Okay, they sell them to us, and we pay for them. Okay, so everything works in this circular flow model. Okay, that's how the money kind of revolves. Okay, so why does it work so well? Okay, Self-interest. Okay, Adam Smith wrote The Wealth of Nations, talked about one's own personal gain. So we're doing what is best for us, and this is both the buyer and the seller. Okay, buyer wants to do what's best for them, seller wants to do what's best for them. Okay, and in the end, it'll work out because they're both trying to get the best deal. Okay, so we're going to shop where we can get the best deals, and they're going to try and sell it to us and give us the best deal because they want our money instead of our money going to a competitor. Okay, so they work so well because of self-interest. Okay, also competition. All right, competition helps grow the market. Okay, so remember incentives, expectations that encourage people to behave a certain way. All right, in the market, there are lots of businesses, lots of producers that are working and struggling to get our hard-earned dollars. We make money, we want to spend it in the right places. So they have to struggle and come up with the best product or better products, better price in order to get us to hand over our dollars to those businesses. Okay, you work hard for your money, you don't want to just throw it away. You want to get the most out of your money. Well, they have to compete for that. Okay, producers have to compete for our money. If they don't, we're going to go somewhere else. We're going to go to a different store. We're going to get a similar product at a cheaper price. Okay, all this boils down to the idea of the invisible hand. Okay. And this is that idea that the market will continue to work as long as the government does not interfere, because businesses will always want to earn our money, and we will always want to go to work to have money to spend and buy all the things that we want to do. Okay. So to finish it up, okay, markets, places where people exchange things, buyers and sellers. Okay, they're free markets, so you can go to the store, not buy anything. If the seller doesn't want to agree to sell you something at that cheap, you don't. They don't have to. Okay, it is what it is. Okay, we're all going to act in our own self-interest. Okay, and there's going to be plenty of competition so that the buyer and the seller gets the best price. Okay, the best possible outcome.